What's going on? Alex here with Efros Financial, and today I'm going to be covering some of the major changes in the tax code that may be applicable for your situation in 2018. Now, most of these have to do with the Tax Cuts and Jobs Act, but I'm also going to be covering other major changes as well. Now, I know that you might be interested in only particular parts of this video, so what I'm going to do is put the time codes for each section down in the video description so you can click on exactly the sections you're interested in watching. Now, with all that out of the way, let's get started. The first thing I want to cover is the new Form 1040. Where do I begin? All right, let's take a step back. In 2017, and many years up to that point, there were 2 pages that summed up your federal tax picture pretty much in its entirety. So putting the schedules aside, Schedule C, Schedule D, and so forth, you could pretty much get an idea of someone's entire tax picture with 2 simple, beautiful pages. Then the idea came along to compress the tax return down to a postcard filing so that it was meant to simplify the tax filing process and reduce the amount of time necessary to file a return. The issue is that instead of actually simplifying anything, they essentially cut up the Form 1040 and put those additional lines on separate schedules. That's all they did. So while the postcard itself is a lot shorter, you're going to have to attach a multitude of schedules to your return to create a complete tax return. Now, whereas in prior tax years, you can only lose up to 2 pages of your federal return, now you get to lose up to 8 because there are 6 separate schedules that you have to include with your return, if applicable, for it to be a complete tax return. Now, this is the idea of simplification, which to me doesn't make any sense because essentially it's kind of like losing weight by chopping your arm off. I mean, you accomplished the goal, but the way you got there was a little bit ridiculous. And I think it was rushed for them to put out this postcard filing and to get all those other schedules made just so you can attach it to the return to kind of create a Frankenstein 1040, whereas before it was 2 simple, beautiful pages. So I don't know if I agree with this one too much. I just don't know about this change. I think the fact that they got rid of this form is absolutely insane. But hey, that's what we have to deal with now because the 1040 and the 1040EZ that existed in prior tax years, they don't exist anymore. So we don't have a choice one way or the other. This new postcard 1040 has to be used, and that's that. So with all this talk of Form 1040, let's take a look at it. So first, let's begin with the walk down memory lane. This is the 2017 Form 1040, which should look extremely familiar. You have your information up here, your filing status, you put your exemptions down right there. You have pretty much all of your income. You have your adjustments to arrive at gross income. Beautiful, elegant. Then on page 2, they even took the time to remind you what your AGI was from line 37 on line 38. They were thinking. So over here you have your taxes and credits. If you have alternative minimum tax, it's all right there. Then you have your other taxes. So if you have self-employment taxes on Schedule C, it's right there. You have your payments, any payments you made throughout the year, withholdings and so forth there. Any refund that you're eligible for and so forth. You can assign a third-party designee. It's beautiful. This is a refined, classy tax return. This is a tax return you could take home to mom. All right? And most of the information we needed to assess a client's tax situation was included right there. It's beautiful. Now let's take a look at 2018's version. All right, so this is the 2018 postcard, the front of it. There's 2 sides. So as you can see, you still get to list your dependents and so forth, and then boom, you get right to the signature. Whoa, what about all the other information? Well, that's included on page 2 of the postcard. Here you can put in your wages, your tax-exempt interest, qualified dividends, ordinary dividends, and so forth. So this will encompass a very basic income situation, and it may be all you need to file if your situation is very simple. But let's take a look at the schedules that you may have to attach to your return. As I mentioned, there's 6 of them. So Schedule 1 has additional income and adjustments to income. Now this should look very familiar because most of these lines come straight from the first page of the 1040. Now Schedule 2, as you can see, this is a great use of real estate. I can't imagine how many trees are going to die for this schedule here, but it is what it is. And now here, if you have alternative minimum tax implications, you get the pleasure of including Schedule 2 with your Postcard 1040. Now it's getting a little bit more crowded. So Schedule 3 covers non-refundable credits. So if you have a foreign tax credit or something like that, if you receive dividends from a foreign stock, then you can include Schedule 3 with your return as well. We should start charging by the form. Note to self. So Schedule 4 deals with other taxes. So if you're self-employed and you have Schedule C, you'll probably see Schedule 4 attached to your tax return as well. Now, Schedule 5 deals with other payments and refundable credits. So if you have the net premium tax credit, this is where you'd find that. So you'd have the pleasure of also adding Schedule 5 into the mix. And Schedule 6, again, great use of space, well thought out, deals with your third-party designee information. So many times when we fill out tax returns for clients, we're assigned as a third-party designee. So just for that, we're going to have to include Schedule 6 with the tax return. Whereas before, it was part of the two-page 1040. And I don't know why they couldn't place the Schedule 6 information over here with Schedule 2. Who knows? But that's how they did it. And unfortunately, we're stuck with this moving forward because it's not going to change, at least for tax year 2018. Now, this Form 1040 is crude, it's crass, it smokes cigarettes and throws the butts on your rose garden. That's what I think of this form. And there's just so much wrong with this. In a few years, and this is just my prediction, I think that Congress is going to come to their senses. They're going to take a look at how ridiculous this is. And they're going to recombine all of these separate schedules back into an elegant, beautiful, easy to read, two-page document. And they're going to call it the simplified Form 1040. That's right. I predict that we're going to come full circle, and a few years down the line, they're going to get rid of this nonsense and go back to a sensible tax form that consists of 2 pages and has basically all the information you need. So a few years down the line, if I'm correct, I'm going to reference this video and point out to people what a genius I am, because I saw it coming. I don't see that this is going to last because it just makes no sense from my perspective. So at this point, I think we should take a moment of silence for the 2017 Form 1040. You've served us well. Now let's talk about the standard deduction for tax year 2018. To say that it's increased is an understatement. For single filers, you get $12,000 as a standard deduction. For married filing joint filers, you get $24,000 in the standard deduction. So what that means is essentially the threshold to itemize is a lot higher. Now, while everybody's getting a standard deduction in terms of that being a freebie, so to speak, what it does is limit the benefit of your charitable contributions, of your property taxes, of your state income taxes, and we'll talk about additional limits applicable to those items a little bit later. But what it means is that you need to have so much more in itemized deductions to exceed the standard deduction in tax years 2018 and moving forward. So on one hand, it is a benefit. It may be also a detriment to the fact that most of the tax benefits that you were enjoying in 2017 and other tax years may not be applicable for you moving forward, because that's pretty much going to be taken care of by the standard deduction. So a lot fewer taxpayers moving forward are going to be itemizing, given that the standard deduction has been increased to be so high. So let's take a look at exactly what those numbers are. Now in 2017, you could see that single or married filing separate, the standard deduction was $6,350. In 2018, it's been increased to $12,000. Now in 2017, if you were married filing joint or a qualified widower or widow, then you would get $12,700. In 2018, that amount's been increased to $24,000, so really substantial. Now finally, head of household was $9,350. In 2018, that amount is now $18,000. So substantial increases there. It's pretty much a tax benefit for everyone, but again, it may decrease the tax benefit you get from charitable contributions and other Schedule A deductions that you were enjoying a tax benefit from in prior tax years. So it's important to take that dynamic into account, and we'll cover more of the Schedule A changes a little bit later, but that's a definite huge benefit that most taxpayers are going to benefit from in tax years 2018 and moving forward. Now let's talk about exemptions. Those are the amounts that you were able to claim for dependents and for yourself. In 2017, it was $4,050 per individual. So essentially, if you are a married couple, you'd have 2 exemptions. If you had 2 kids, you probably had another 2, so you had 4 exemptions. All of that is gone for tax year 2018. So the personal exemption and the dependency exemption do not give you any tax benefit whatsoever. It doesn't exist. So whereas in 2017, you might have been relying on the standard deduction plus your exemptions, or your itemized deduction plus your exemptions, now you just have the increased standard deduction and you don't have the exemptions to further decrease your taxable income. So that's been eliminated for tax year 2018. So let's take a closer look at how that works. Now in 2017, this should look familiar. You had an exemption for yourself and for your spouse if you were married. So that would give you 2 right there. And then you would list your dependents. And if your dependents met certain requirements, that's where you'd list them. So this would be your son, your daughter, your lazy cousin who eats all your snacks and never pays rent. You might include that person there. And the total number of exemptions was multiplied by 4050 in tax year 2017, and that gave you your total exemption amount. Now in 2018, while you'll notice you could still list your dependents, what this is going to help with is getting you any credits that you may be eligible for. This is not going to generate that exemption amount that was applicable in 2017. Because as I mentioned, in 2018, exemptions are no longer a thing. They're not applicable. You only have your standard deduction, or if you have enough itemized deductions to itemize, you have your itemized deduction, but you don't get an additional decrease to your taxable income from any exemptions. So that's an important change to keep in mind as far as exemptions go. Now let's talk about the new $10,000 limitation for state taxes. Now this is pretty huge, especially for the states on both coasts that have a high cost of living and high property values. What that limitation basically means is if you have state income taxes that you're paying throughout the year through withholdings or estimated tax payments, and if you're making property tax payments for your, let's say, your residence, those are subject to a new limitation of $10,000 in total. Now this is a huge change for someone who might be, let's say, paying $50,000 in state income taxes through withholdings or estimated payments and another $20,000 in property taxes. That was $70,000 that they could essentially apply directly to their Schedule A in 2017. In 2018, that entire amount, both the state income taxes and the property taxes, is limited to $10,000. So no matter how high those amounts are, there's a ceiling on the amount of benefit that you can actually have on Schedule A from those amounts. Now, people on the coastal states are affected by this on East Coast and the West Coast because their property values are high, the cost of living is high, so there's a good chance that they're going to be paying a lot in property taxes and a lot in state income taxes. But that's a limitation we're going to have to live with going forward. Let's take a look at the Schedule A in 2017. I'll show you exactly what I'm talking about. Now, this line 5 here deals with income taxes and general sales taxes. Usually, if your state assesses an income tax, then the income tax box is checked off here because that's the higher amount, and you would list that amount here on line 5. Now, in line 6, in the real estate taxes, you would put in all the property taxes you paid throughout the year, and both of those amounts would add up to a deduction for you on Schedule A. It would filter down to this amount here to amount to your total itemized deductions. Now, in tax year 2018, my software doesn't even have the Schedule A available, so I'm not able to show it to you, but essentially that limitation is in place. So you're going to have to figure your taxes with that in mind. Now, while you may have a much lower itemized deduction, again, remember that the standard deduction has been substantially increased, which may offset some of that detrimental effect of the decreased itemized deductions by increasing your standard deductions. But depending on how your taxes are structured, you may end up either ahead or behind. So that's an important change to keep in mind, and it also affects you from a planning perspective, because we used to be able to time property tax payments into particular tax years to allow for the maximum deduction. Now that's going to have a much reduced effect, and that's not going to be as much of a planning opportunity going forward to mitigate taxes in one tax year or another. So that's the change that has to do with Schedule A. It's the new $10,000 limitation on your state income taxes and your state property taxes. Now, with the higher standard deduction and the new limitations on the real estate property taxes that you can deduct, all I could say is it makes my one-bedroom rental in Hollywood look that much better. Another area that was affected by the Tax Cuts and Jobs Act is miscellaneous itemized deductions. Now, these were the deductions that were subject to the 2% floor in Schedule A, which means that if they were high enough to exceed 2% of your AGI, or adjusted gross income, then they would generate an additional itemized deduction for you, which could be used to reduce your taxable income. Now, for 2018, these have been eliminated completely. Now, what am I talking about? Let's take a look at 2017 for a little bit of historical reference here so you know what I mean. Now, if we look at Schedule A from 2017, we scroll down here and you can see that there's unreimbursed employee expenses that falls into this miscellaneous itemized deduction category. That includes job traveling, union dues, job education, so forth, and continuing education that you take for your work. And a lot of these expenses would be included on Form 2106 typically. They're no longer deductible, so it's not applicable to the tax return any longer. Tax preparation fees. Some tax preparers charge egregious tax prep fees. Those are not going to be deductible any longer. And investment expenses such as management fees, they would typically fall into this category. Again, no longer applicable. Safe deposit box expenses and all of that, that's all been eliminated by the Tax Cuts and Jobs Act. Now, there's a little bit of uncertainty whether some trust administration expenses may sneak through here, but for the most part, if you were taking 2% miscellaneous itemized deductions for, let's say, your job where you were incurring expenses that you weren't being reimbursed for, that you were deducting travel expenses for your job, or if you had significant investment management fees that you were deducting, all that is no longer applicable for tax years 2017 moving forward. Now, keep in mind, investment interest is still deductible. So this limitation does not affect, or this change, I should say, does not affect investment interest. But keep in mind, if you have investment expenses, so you're paying someone to manage your money, those expenses are no longer going to be deductible as a miscellaneous itemized deduction subject to the 2% floor. So these are some of the changes that are important to consider when you're thinking about what your deductions might look like for 2018 and future tax years. Believe it or not, we're still not done with Schedule A. That's right, there's more. Let's talk about home mortgage interest. Now, in tax year 2017, you are able to deduct the interest of up to $1 million of mortgage indebtedness, and then you can also tack on an additional $100,000 of home equity debt for which you can deduct the interest. So that essentially bumped up the principal amount for which you can deduct interest to $1.1 million in total. Now, in tax year 2018, the new limitation is that you can only deduct mortgage interest on $750,000 of mortgage indebtedness, and that home equity portion was completely done away with, so it's no longer applicable. So going forward, for new mortgages, you're going to have to deal with the limit of $750,000 as the principal amount for which the interest is going to be deductible. Now, the question is, well, what about my existing mortgage? You know, I was able to deduct the interest on the full $1 million. Is that going to be applicable going forward? So for existing mortgages, they're actually going to be grandfathered in, and the limitation of the $750,000 is not going to apply to existing mortgages. And also, if you got a mortgage toward the tail end of tax year 2017, basically from December 15th to the end of the year, then you can essentially be grandfathered in under the old rules. Now, any mortgages moving forward, you're going to be subject to a limitation on the interest deduction to the first $750,000 of mortgage indebtedness, and that home equity debt portion doesn't exist anymore. So the entire limitation went from $1.1 million for the mortgage and the home equity down to $750,000 in total, no home equity interest deduction moving forward. Now let's touch on alternative minimum tax, otherwise known as AMT, otherwise known as that tax that I have to pay. I can't believe I have to pay this. The change there is that the amount of income that you need to earn now before you're subject to the AMT is a lot higher in 2018 as opposed to 2017. So if your, let's say, W-2 wages were substantial in prior tax years and you were getting hit with that AMT year after year, in 2018, the extent to which that's going to be applicable to you is going to be reduced. Now, without getting into all of the brackets, exemptions, and so forth, just to keep it really simple, if you compare 2017 to 2018 and keep everything constant, there's a really good chance that your exposure to the AMT is going to be greatly reduced. So with individuals with a higher income that were subject to AMT in prior tax years, this is welcome news. And overall, it may definitely reduce the amount of tax that you're subject to, since the AMT is not going to be there to bump up the total tax that you're going to have to pay. While we're on the topic of individuals with high income, it's also important to note that the limit on itemized deductions has been eliminated for tax year 2018. So if you're making a substantial income, let's say $300,000 to $500,000 or more, then if you have significant itemized deductions, again, we have to take into account the $10,000 limitation, the elimination of the 2% miscellaneous itemized deductions, and so forth. So even after all that, if you manage to have substantially high itemized deductions and substantially high income, your itemized deductions are no longer going to be decreased. So that limitation is gone thanks to the Tax Cuts and Jobs Act. Another important change brought on by the Tax Cuts and Jobs Act is the QBI deduction, or the Qualified Business Income Deduction. Now, this is huge for those of you who have self-employment income. So let's say you're a sole proprietor, or you have a partnership or an LLC that you're a member of, and then you get pass-through income through Schedule K-1, or if you're the owner of an S corporation and get pass-through income that way, then you can benefit potentially from the QBI, or the Qualified Business Income Deduction. Now, this is probably the most complex area of the new tax law because it has so many phase-outs, exceptions, and so forth. But on a very basic level, if you have self-employment income, let's say you're a single-member LLC, or you're a sole proprietor, or if you have, as I mentioned, pass-through income from a LLC or a partnership, or even an S corp, then you can benefit from this 20% deduction to your taxable income, essentially. So your qualified business income can be reduced by up to 20%. Now, there's a whole series of exceptions, of phase-outs, as I mentioned, and other complexities that need to be considered. This is not a simple tax law. But in many situations, if you have income that you're generating as a small business and it's passing through to you, then an analysis for tax year certainly needs to be done to see if you qualify for the QBI deduction. Now, 20% is fairly significant. So if you have $100,000 in QBI, or qualified business income, in 2018, this deduction theoretically could amount to $20,000 that you're not going to be taxed on. So just as corporations got their tax rate reduced, this was a way to allow the small guys, so to speak, to also benefit by reducing the amount of tax that they'd be subject to if they have QBI. Now, if income gets substantially high, then the QBI is limited or even eliminated if your income is high enough and you're in particular fields of business. Now, again, I mentioned QBI can be a video in and of itself. I wanted to cover it on a very basic level. But if you have self-employment income or pass-through income from either partnership, LLC, S corporation, and so forth, then an analysis needs to be done for tax year 2018 to see whether you qualify to have that QBI deduction, and also the extent of that deduction. So that's a conversation we're definitely going to have if you're a client with a Schedule C, or an LLC, and so forth, or a partnership, and we're going to get into the specific details to see how you can most benefit from that deduction. But that is new for tax year 2018. It was not available in prior tax years, and there's still a little bit of gray area in terms of where exactly it's applicable and where it might not be applicable, but certainly anybody with pass-through income may potentially benefit from this tax change. Enough of all this tax talk, let's dance. All right, enough of that. Another benefit afforded by the Tax Cuts and Jobs Act relates to C corporations. And that's because the maximum tax rate for C corporations has been reduced from 35% all the way down to 21%, which is a huge tax benefit if you have a C corporation that was actually paying taxes. You're going to notice a far reduced tax bill in 2018 as compared to prior tax years. In addition, the AMT, or Alternative Minimum Tax for corporations, has been repealed for 2018 and moving forward. So corporations that were paying additional taxes because they were subject to AMT implications, that's no longer going to be the case moving forward. So these are some tremendous tax benefits for C corporations, specifically that are afforded by the Tax Cuts and Jobs Act. So that wraps up the Efros Financial Annual Tax Update. I hope you had as much fun watching it as I had making it. We like to keep it fun, we like to keep it entertaining, but above all, we like to keep it educational. So hopefully this has helped you envision your tax situation in this year and in future tax years and help you with planning and so forth, because that's where the real value add of tax work comes in. It's not from typing in W-2s. It's from actually doing planning so you can be proactive in improving your situation and increasing your tax efficiency. Now, if you're already a client of ours, thank you so much. I appreciate you. If you're not a client yet, what are you waiting for? Join the family. Now, all of our clients are going to receive correspondence about tax year 2018 in December of 2018. So that's going to include emails, tax organizers, additional information, and so forth. We've got you covered. Now, if you're not a client of ours yet, we're going to reach out towards the end of the year to touch base regarding the 2018 returns and take it from there. Moving forward, we're going to be uploading more videos to this channel that have to do with financial planning and taxes, so definitely subscribe down below, hit the like button if you enjoyed the video, and hit that bell icon so you're notified of future videos as soon as they're released. And I do realize that for some of you, this is the first time seeing me in anything but my picture on my website, so yes, the hair is real.